I'm about to broadcast, Graham, so it's over to you.
The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon from Melbourne, Australia. This is Graham Critchley speaking. I'm the convener of PIGS, which is an acronym for the PXUPA Investor Group Supporters. PIGS is a volunteer action group that has actively represented the financial interests of all PaperlinX hybrid investors since January 2012. But first, some basic housekeeping matters. I have two roles today, convener, and I'm one of the three presenters. Behind the scenes, we have a webinar organizer who is pulling the levers. Please understand this isn't a megabucks YouTube video with auto cue prompts. This is from the hearts of seriously concerned volunteers. At the end of this presentation, we have allowed time for your questions. You will notice that the GoToWebinar software has provided you with a small control panel on your screen. This allows you to type in questions during the presentation that we will attempt to answer when the presenters have finished speaking. If we run out of time, we will post your questions and our answers on the website. You should be aware that we will be recording this webinar and uploading it to the PIGS website by about 8:30 tonight. Well, why are we here? This webinar is intended as a wake-up call to the board. There are a lot of people working very hard in the various business units of PaperlinX worldwide. That's accepted. This board needs to work hard on the business. By that we mean the balance sheet, which necessarily means dealing with the hybrids. Remember, gentlemen, that was an undertaking you made at the 2012 AGM. It's really simple. Managers and their staff work in the business units, and the board works on the business structure. Today I'm joined by two colleagues from the PIGS committee, Paul Waterstone, who is an accomplished equities analyst of industrial companies, and Justin Epstein, who is well versed in responsible entities and managed investment schemes. We say that the financial position of PaperlinX hybrid investors is a serious matter and ultimately affects all PaperlinX stakeholders. But first, some brief background. $285 million was raised by PaperlinX in 2007 when it was a blue-chip ASX company with a market cap of about $1.7 billion. 6 years later, PaperlinX is a penny dreadful stock with a market cap ranging between 30 to 35 million. Believe it or not, it has nearly 40,000 shareholders stranded with less than a marketable parcel of $500 worth of shares. The 285 million of hybrid equity stroke debt is now trading on market at less than 10% of its issue value. But we believe it is worth significantly more if the hybrid holders act collectively. Let me be very clear on this. If the hybrid holders act collectively and stand up to this board, we will realise far more value from our investment. The reasons we are acting now are fourfold. I want everyone to understand why. Firstly, we've given the new board 9 months breathing space since the 2012 AGM and received next to no communication. And this is despite the fact of the board's firm assurances there would be dialogue and that the hybrid holders are the majority holders of the net equity of PaperlinX. I need to put this in perspective. As at December 31st, 2012, our equity contribution, that's the equity contribution, stood at 76% of PaperlinX's net equity, and we expect it will exceed 80% next week upon release of the 2003 accounts. Secondly, we are very concerned about the corporate governance of PaperlinX generally. Things that were promised to shareholders and hybrid holders have not been delivered. Thirdly, we are deeply concerned about the parlous state of the balance sheet of PaperlinX. In our opinion, the commonly held belief that the hybrid equity stroke debt is simply a $285 million interest-free loan is foolhardy for a business under financial pressures currently suffered by PaperlinX. The hybrid debt is really a noose around the neck of the business and its ordinary shareholders. Something has to happen, and the sooner the better. We say that in the absence of initiatives by the board, it is incumbent upon the hybrid holders, that is the 76% equity holders, to make constructive suggestions that in turn protect our investment and hopefully everyone's livelihood. Fourthly and finally, we will today address what I call the reserve powers of hybrid holders. Despite misinformed popular belief, hybrid holders have powers. Ordinary shareholders and hybrid holders ought to understand, wherever they are in the world, exactly what those powers are. I'll conclude my opening remarks by telling our overseas friends a little about PIGS. Gabby Berger and I are both self-funded retirees and have been actively pursuing the rights of hybrid holders since late 2011, which is now 21 months ago. We are fortunate to enjoy excellent technical support from three young professionals, that being Paul, Simon and Justin. As far as Gabby and I are concerned, shareholder apathy isn't in our DNA. Here are three things everyone ought to know about PIGS. We have provided constructive solutions to resolve PaperlinX's balance sheet problems, which have been ignored. We are well organised, and we have more resources at our disposal than most people give us credit for. We genuinely and sincerely don't seek open hostility with the board. However, it's about time there was more accountability and transparency about the business generally and the balance sheet specifically. Regrettably, accountability and transparency seem to change with board incumbency. Okay, that concludes my opening remarks as convener. I'll now magically hand over to myself as the opening presenter and address board governance and board composition and corporate governance. Paul Waterstone will then address the balance sheet and what to look for in the 2013 results. And finally, Justin Epstein will address the options, or what I term the reserve powers held by the hybrid holders. We'll then have a Q&A session. Please feel free to submit your questions anytime during this webinar using the control panel on your screen. If you require further information, please don't ever hesitate to contact us via our blog site. And here is a special note for our UK attendees. We won't be accepting questions about the cricket. I wish to address 6 matters today, and there they are. I can assure you PIGS has been quietly but professionally active. Meanwhile, PaperlinX has apparently done nothing about its capital structure. Excuse me just one moment. So who's been doing what? Well, you can read that exhibit there, which is slide 8. The saddest thing about this exhibit is that we are reliably informed that staff morale at PaperlinX UK is now at rock bottom. So we've got disaffected staff and we've got disaffected equity holders. The time for board action is now long overdue. Here's a timeline of the last 12 months since the 2012 AGM. You may view this timeline at your leisure as it's on our website. Be assured we are proactive. Now this is a very important exhibit. Most investors will know the profiles of the board members, but who are the other powers behind the scene? Lawrence Rodney is a low-profile but highly successful Sydney businessman. He holds 2 interesting relationships. One, he has told me that he has had a 50-year relationship with the current chairman, Robert Kay. Fair enough. And it's on the public record that he was at Andrew Price's side from early 2012. Some of you may remember his appearance at the EGM in March 2012. Moving on to item 3 there, it's also well known that Andrew Price and Raymond Gonzalez were neighbours a few years ago in Paddington, Sydney. Today, Mr. Gonzalez is a substantial shareholder and a paid consultant to the board. This could look like jobs for the boys. And whatever happened to Moelis & Company, the global investment bank? Look, I'm not suggesting any conspiracy theories here. We all have friends and neighbours, but this turnaround of PaperlinX is being driven by a board and its close supporters, none of whom have any proven experience in running a troubled multinational industrial company. Not one of them. Individually talented, undoubtedly, but do they have the right talents for the task at hand? The fourth interesting relationship is between Andrew Price and Chris Crichton. Chris Crichton has had a stellar career in paper merchanting, starting off at Spices in Sydney at about the same time as Andrew Price. That was in the early 1980s. And he rose to become President of North America, Australia, New Zealand and Asia. Around the same time that Andrew Price left Spices, that is in Sydney, to become a successful entrepreneur with Stream Solutions, at that same time, in about 1997, Chris Crichton relocated from Sydney to run PaperlinX USA. When the former board sold off Spices USA in June 2012, it decided that after 31 years, the highly successful Crichton was no longer needed at PaperlinX. That was pretty odd, because in recent years he was responsible for the only profitable PaperlinX companies, that is the Pacific Rim, which he ran from Seattle. In February this year, he resurfaced as a consultant to PaperlinX in Europe. But what has happened since early July when his initial contract expired? I can tell you. Not one word from PaperlinX. This is a key question. Is Chris Crichton staying or going? As an aside, I should note that there are some outstanding leaders in PaperlinX, especially in the Pacific Rim region. Just to mention a few. Corey Turner, President of Spices Canada, Andy Priest, Executive GM of Australia, New Zealand and Asia, and Ken Booth, recently appointed GM of Spices Australia. All solid guys with strong track records. I'm sure there are equally good guys and girls in the UK and Europe. It's just that I don't know of them. For those employees who are listening, let me be very clear about the people side of PaperlinX. This isn't a fight between capital and labour. It's a fight between the used and abused capital providers, that is, the hybrid holders, and those entrusted to manage this capital, the board. It's that simple. Now, reverting back to exhibit number 10, the real mystery is the role of Dave Allen. Everyone knows that Andrew Price is calling the shots in the UK and Europe. Loathe him or love him, he has lots of energy and a strong personality. It defies logic why he isn't MD. I've met Dave Allen twice and he seems a decent bloke, but he and Andrew Price are like chalk and cheese. I stress this isn't a criticism, merely an observation. Finally, let's look at the relationships numbered 5 and 6 on this exhibit. It's no secret that I personally gave Andrew Price strong support in toppling the former board. I really like the guy. There's no doubt about that. I really like him. These days, Andrew is busy running operations in the UK and Europe and wherever else. Besides, liaison between the board and PIGS was formally transferred to Robert Kay at the 2012 AGM. That relationship, noted as number 6 and red, is now virtually non-existent, but more about that later. Finally, it ought to be noted who has what money at stake here. Mrs. Rodney and Gonzalez are definitely committed with their holdings of ordinary shares exceeding 5%. I can assure everyone listening tonight that the PIGS committee has far more hard cash invested in PaperlinX than has the board of PaperlinX. That is a fact. Further, my fellow committee man Gabby Berger and I each have far more hard cash invested in PaperlinX than Andrew Price. That too is a fact. Well, I guess you've had enough of facts. Let's move on. I'll let you read what the chairman said. Chairman Mike Barker was unambiguous. We consider that the board urgently needs a fourth and truly independent director to improve governance. I'd like everyone to read this carefully. Then think about the real meaning behind the term strategic rotation after just 6 months. Now, I've met Wayne Johnston, so I feel I can say this to him. Come on, Wayne, surely you can do better than that. Here is another extract from the chairman's speech at the 2012 AGM. Now, Robert Kay is a really bright guy. He holds a doctorate of laws with honours from Cambridge and is a senior counsel at the New South Wales Bar. For our offshore attendees this afternoon, senior counsel in Australia is the same as a QC in the UK. So why would I pick a fight with him? It's because on the matter of board structure and governance, I believe that on this occasion we are right and he is wrong. Here's an example. PIGS was scheduled to have its first formal meeting with PaperlinX and its professional advisors this coming Thursday, August the 15th. That's the first ever in 9 months. And may I suggest, probably strategically designed so that Robert Kay could make a feel-good statement at the AGM. The meeting was cancelled by PaperlinX after it became aware of this webinar. Now, this webinar was never a secret and reveals nothing not already known to the board and its advisors. we are simply updating our supporters at this important time. We, the PIGS, are totally transparent. Here is the fundamental problem we have with Chairman K. He has done absolutely nothing in 9 months to, quote, deal with the hybrids. And, despite his obvious professional skills, he has avoided engagement. I'll now read from his bio, which is available on the PaperlinX website. Remember, these are his words, not mine. He, that is Robert K., has had significant mediation experience and has been involved in the successful resolution of complex commercial disputes. That's what he said. What's gone wrong here, Mr. K? Now here's an extract from the CEO's speech. The question is obvious. What's happening in the Netherlands and Germany? When will the board tell us? Hopefully soon. We truly don't want this to become a conflict of personalities, but what really went wrong in the first 9 months? I was an unabashed supporter of Andrew Price toppling the former board simply because they were in la-la land. However, maybe he's now not the right guy, and here I stress there is no intended disrespect to Andrew. The skill set of an ambitious, energetic Aussie entrepreneur isn't necessarily the same as that required to stabilise and turn around a troubled multinational business. I'd like to draw your attention to specifically to item 4 on this exhibit. Did everyone forget about the hybrids? The hybrids were in place years before Andrew Price and his supporters arrived. Didn't they have a plan to deal with the balance sheet? Or is it a devious plan yet to be revealed? This exhibit number 16 is self-evident. The hybrid holders have foregone or lost $15 of distributions over the past 2 years, and that is roughly twice the current price of each hybrid. No wonder the asset strippers are now casting an eye over PaperlinX. I'm certain you'll hear more about potential predators soon. This is my last exhibit, and I've saved what is either the best or worst for last. It's why I call the Armageddon or nuclear option. At the present share price of, say, 4 to 6 cents per ordinary share, forced conversion will yield the hybrid holders about 90% control of the ordinary share register. And this could happen. Look, I'd now like to hand over to Paul Waterstone, who's one of our analysts. Over to you, Paul.
Thank you, Graham, and good afternoon to everyone who's joined in today's webinar. Well, my name is Paul Waterstone, and I'm an equity analyst by profession, specialising in researching and valuing listed industrial companies. I'll be presenting the financial section of today's webinar, and we'll be taking you through 3 key areas. First, what to look for in PaperlinX's 2013 full-year results next week. Second, regional revenue and EBIT forecast by region. And third, explaining why PaperlinX's balance sheet needs to be fixed. It's important to note from the outset that under ASX guidelines, a company should inform the market when it becomes aware that its results are likely to be materially different from the previous corresponding period. Now, given PaperlinX hasn't made an ASX announcement otherwise, we expect the FY13 earnings will be within 15% of the FY12 result. What to look for in the 2013 results. As an investor and analyst, here's what I'll be looking for in the results. Absence of disclosure. Up until the FY12 full-year result, PaperlinX disclosed hard numbers on volumes of paper sold by region, which is a very important metric in a business with significant fixed cost leverage. If disclosure on volumes is missing, we can't establish if the strategy of cutting costs is resulting in market share loss, which is potentially a significant issue in the UK. Furthermore, disclosure on new product lines is important to determine to what extent new products are filling the void left by the decline in paper, i.e., how much the diversified strategy is actually impacting on profitability. An explanation of what went wrong in the UK, especially considering the CEO's comments in June 2012 that the region was trading profitably and was expected to enhance its profitability further, something must have gone very wrong considering the UK contributed significantly to the large loss in Europe 6 months later, when restructuring benefits which had been flagged should have been accruing. Working capital on the balance sheet. This should have improved since the half year, and if it hasn't, it suggests heightened risk due to less free cash to repay debt and fund contingencies. Other items to pay attention to include cash outflows to top up pension plans and cover restructuring costs. A pension outflow in excess of the $10 to $15 million guidance given by the company may indicate that the pension plan trustees are concerned about the viability of the business. On a side note, the pension plan represents a large future obligation for PaperlinX, around which there is material uncertainty given the present inability of the UK business to fund them using internal cash flows. This creates a contagion risk for the remainder of the business, should calls be made on the UK pension plans. And there is a real risk of PaperlinX becoming a zombie company, operating merely to service the runoff of these liabilities. In the regional disclosure, key indicators outside of Europe will be whether the margin performance delivered in ANZA in the first half has been sustained into the second half, and an indication of whether the headcount reduction and drive to sign new accounts in Canada has improved margin beyond the first half's 2.5% result. Also keep an eye out for details on director and consultant remuneration in the reports. The lack of independent directors is a concern when it comes to remuneration matters, as evidenced by the poor disclosure surrounding the options package announced last year. Going across now to forecast by region, we'll begin with Australia, New Zealand and Asia. Here we are forecasting a moderate decline in revenue due to market contraction and the insolvency of Geon, one of PaperlinX's major Australian customers. As a result, we also expect the second half profit will be down on the first half, both in dollar and margin terms. The bad debt write-off will likely be allocated to significant items. After the double-digit decline in Australian volumes in last year's result, we'd also be looking for some level of comfort that volumes have in fact stabilised. Moving now to Canada, the region delivered profit and margin growth in the first half, despite a 7% decline in revenue, which is an impressive performance. We are cautiously optimistic that the 10% reduction in the Canadian workforce implemented over the period hasn't had too much of an impact on revenue in the second half. In terms of profitability, there's potential to surprise on the upside here if there's been a strong enough flow-through of cost savings from restructuring. Lastly, in UK and Europe, we expect a 5 to 10% decline in local currency revenue due to loss of market share and continued industry contraction. This will be partially offset in the consolidated accounts, which are given in Australian dollar terms due to the depreciation of the Australian dollar over the period. We expect a full-year operating loss in the region to be worse than the €17.8 million loss in 2012. The uncertainty around whether or not the UK and Europe restructuring is actually working makes it extremely difficult to forecast profitability with any degree of accuracy. Although over 300 redundancies have been made, there has been no indication that the businesses have actually hit bottom and turned back towards profitability. For this reason, the UK and Europe result may be significantly worse than the €24.3 million forecast in our base case. This being the case, it may demonstrate the restructuring effort is not enough to realise PaperlinX's aspirational goal of returning the group to a profit by 2014. It's also important to bear in mind that managers tend to underestimate the cost, extent and duration of restructuring programs and to overestimate the benefits. PaperlinX Benelux, for example, has been restructuring for 7 years, since 2006, and is still losing money. Over the same period, revenue has halved in that business division. We will be looking for signs that the substantial first half loss in the Netherlands has been turned around, and if it hasn't, reasons why throwing more cash at the problem is better than selling up and walking away. Moving now to why the balance sheet needs fixing. The situation with PaperlinX's UK and European operations is closely tied to the urgency of fixing the balance sheet. Here we need to understand that PaperlinX's key problem in loss-making regions is poor utilisation of its warehouses, of delivery vehicles and of staff. In a poor volume environment, when assets are being used at only 50 to 60% of their capacity and you can't cut fixed costs fast enough to offset the volume decline, profitability inevitably suffers. We see this in the UK moving from a profit in June 2012 to a significant loss just 6 months later by December 2012, and this despite a headcount reduction of over 10%. The question that needs to be asked is whether the aggressive cost cutting is causing more problems than it solves. Whilst there is a bankable saving from less salaries to pay, there are often negative impacts of losing customers and accounts when branches are closed and salespeople move to competitors. There is also a significant morale and productivity impact, which can quickly erode the gains from the lower wages bill. Now, this is where capital management and the balance sheet come in. If the strategy of trying to shrink capacity is not working, the other option is to attempt to fill up unused capacity and spread the fixed costs over more volumes. Now, clearly PaperlinX is trying to do this with small acquisitions such as those recently made in New Zealand and Sweden, but being tight on cash and on a short leash with its banks, the business is incapable of investing in acquisitions that buy meaningful volumes. Until PaperlinX addresses its balance sheet, it has no ability to raise capital and very limited scope to take advantage of opportunities which could deliver substantial improvement in utilisation and profitability. In summary, it's clear that something needs to be done. The reality is that PaperlinX needs to be recapitalised, which involves fixing its balance sheet by removing the hybrid, reducing its level of gearing from an unsustainable 424% debt-to-equity ratio, and creating a cash buffer. In its present state, there is not much of a shock absorber to ensure the survival of the business if something goes wrong, and this puts all stakeholders at risk, not only hybrid and ordinary equity holders, but also staff, pension plans and suppliers. At the risk of using a bad analogy, we can imagine PaperlinX as a ship with a thin and fragile hull. Most people on board the ship know that the hull is fragile and this makes them nervous. The captain does their best to allay people's fears, but words are cold comfort against hard facts. What often gets overlooked is that at the first signs of trouble, everyone looks after themselves first and rushes for the lifeboats. The supplier may see risk and tighten their trading terms. The lender may see risk and impose more onerous terms on the debt. The customer may seek to diversify their purchasing with other merchants. The pension plan trustee may call for a few million more in top-ups. And the employees may become demoralised and have lower productivity. Each of these actions pulls a bit of the rug out from under PaperlinX and makes the situation worse. Echoing Graham's contention, this is why the balance sheet is a global PaperlinX problem. Now, if I had $1 for every time I heard someone say, big ships take a long time to turn around, I'd be quite a rich man. But in PaperlinX's case, the odds of successfully turning the ship around would improve substantially if the ship were to be more robust, i.e. if the balance sheet was fixed, so that everyone on board would have some meaningful reassurance of not being sunken by an unexpected storm. In light of this, PIGS have published a presentation available on our website outlining 7 constructive suggestions for fixing PaperlinX's balance sheet, including a divestment of loss-making operations and the conversion of hybrids into ordinary shares, which would simplify the capital structure, reduce risk and open the company to any potential takeover. We put the options to a poll, and as you can see on the right of this slide, the overwhelming response is that something needs to be done. Whether or not that something comes from within or from outside PaperlinX is another matter. I will now hand over to Justin Epstein, who will discuss the options available to hybrid holders. holders.
Paul, thank you for your detailed analysis and useful insights. To our audience, thank you for attending. My name is Justin Epstein and I joined the PaperlinX Investor Group Supporters Committee in March following Ted Dow's resignation. I'm a founder and executive director of One Investment Group. We act as responsible entity or trustee for in excess of 100 trusts with more than $3 billion under administration. I'm also a PXUPA investor and have been since May 2011. I've been asked today to provide a brief overview of the voting thresholds relating to a registered managed investment scheme, such as the PaperlinX SPS Trust, in addition to discussing the possibility of replacing the responsible entity. What I will discuss is a simple summary. It's worth noting that I'm not a qualified lawyer, and these slides do not attempt to provide a full summary of the possibilities or issues that need to be considered. Further, these slides and my comments that will accompany these slides express my personal views and should not be relied upon, but are intended to raise matters for members to consider and discuss further. With that disclaimer, let's start. I will start by providing a summary of the voting thresholds required for various matters, then discuss why we might want to consider replacing the responsible entity, outline the process and what occurs once the responsible entity is replaced, and then I'll provide a summary of the presentation. You will see that this slide outlines the member thresholds required in order for various matters to occur. The first threshold is 5% of votes or 100 members of the PaperlinX Trust. This threshold is what is required to call a meeting to vote on various matters. The second voting threshold deals with an extraordinary resolution, which would be required in the event that members either wish to remove the responsible entity or, alternatively, to terminate the PaperlinX Trust. This is considered quite a high threshold, as it requires 50% of all of the votes that are entitled to vote. This can be materially different to 50% of all the votes actually cast at a meeting, as typically, in circumstances such as this trust is in, where there is a diverse member base, the level of apathy results in many members deciding not to vote. In other words, they throw their proxy into the bin. That is, if they decide to open the letter. The point to note here is that collectively we have power. However, should a vote be called, every member needs to know that their vote is important and that if they believe something should change, they need to vote for the change and not rely on other members carrying the day. The third voting threshold deals with a special resolution. A special resolution is required to amend the Constitution. While 75% might appear to be a high threshold, it should be noted that unlike an extraordinary resolution, a special resolution only requires 75% of the votes that are actually cast. So the apathy issue raised in relation to an extraordinary resolution falls away. Finally, it's worth noting that the reverse of the requirement for a special resolution is true. What I mean by that is that 25.1% of the members have the ability to block any special resolution, as they'll be able to restrict the 75% getting up. Obviously, this 25% is a readily achievable number. If we now turn our attention to replacing the responsible entity, the ALRC report stated that the ultimate expression of dissatisfaction by investors in a scheme is to remove the scheme operator, that is, the responsible entity. The responsible entity's core function is a fiduciary role to the members of a scheme. This was expressed in the explanatory memorandum to the Managed Investments Bill in 1997 and has also been enshrined in some of the statutory duties imposed on a responsible entity. The point I'm trying to make is that the responsible entity needs to look after our interests. That is why the responsible entity is here. If we all agree that the responsible entity is not looking after our interests, then we have the ability to force change. And rather than merely publicly make statements of our dissatisfaction of the performance of the responsible entity's function, we can force change by replacing the responsible entity. But why would we consider replacing the responsible entity? Well, there are many reasons why members might consider changing the responsible entity. As outlined a moment ago, one reason is if we were of the view that the responsible entity was not acting in our best interests. Another reason could be if we were of the view that the responsible entity was putting its own interests before our interests. The important reason would be if we were of the view that changing a responsible entity was likely to force a restructure that was favourable to members. And another reason might be thought that changing the responsible entity might result in a favourable outcome for members. For example, if we thought the incumbent responsible entity undertook misleading and deceptive conduct, and the new responsible entity might take action against the incumbent responsible entity. Let's now turn to how we'd actually change the responsible entity if we formed the view that it would be in our interest to do so. Section 252B(1) of the Corporations Act requires the responsible entity of a registered scheme to call and arrange a meeting of the scheme's members to consider and vote on a proposed special or extraordinary resolution at the request of members with at least 5% of the votes that may be cast, or at least 100 members who are entitled to vote at the resolution. Under Section 252B(6) of the Corporations Act, the responsible entity must call the meeting within 21 days after the request being given to it, and the meeting must be held no later than 2 months after the request is given to the responsible entity. Where a meeting is called for under Section 252B(1), the responsible entity is responsible for the expenses of calling and holding the meeting and may meet those expenses from the scheme assets. As an alternative, should members wish to control the calling of the meeting and the information that is distributed to investors, pursuant to Section 252D(1), members of a registered scheme who hold interests carrying at least 5% of the votes that may be cast at a meeting may call and arrange to hold a meeting of the scheme's members to consider and vote on a proposed special resolution or a proposed extraordinary resolution. However, if the meeting is arranged by the members calling the meeting must pay the expenses of calling and holding the meeting. As mentioned earlier, the voting threshold is 50% of all votes that may be cast by members. So what happens when the responsible entity is changed? Well, there are 3 core changes as a result of changing the responsible entity. Firstly, the new responsible entity steps into the shoes of the former responsible entity. There is a statutory novation of all agreements the responsible entity has entered into on behalf of the scheme. The new responsible entity is deemed to have always been the responsible entity, and the right to hold and rights in relation to scheme property pass to and vest in the new responsible entity. Excuse me. It's now worth mentioning a few matters that we may need to consider. Were any misleading and deceptive statements made in the product disclosure statement? In other words, were any statements made that were incorrect or were likely to create a false impression? It's worth noting that the ability to rely on small print and disclaimers is not an excuse for misleading and deceptive statements. The Services and Indemnity Agreement. This is the agreement buried in the PDS, which enables the incumbent responsible entity to be paid and receive reimbursements despite the trust having no capital. I think it's a little odd that the responsible entity was concerned about this from the beginning. Now we are in a position where the responsible entity knows where its bread's buttered. In my view, it has created a conflict whereby the responsible entity has fiduciary obligations to us, the members, yet it can only spend money that the PaperlinX board approve they can spend money on. Further, in the event a responsible entity is changed, PaperlinX have the right to terminate the agreement. How conducive will this be to an alternative responsible entity? Should this have been considered when the structure was established? Did the responsible entity consider the member's position and the possibility of this impacting members' ultimate discretion to change the responsible entity? Should it have considered this? A very interesting PXUPA specific impact is the activation of the responsible entity removal event and the possibilities this presents the members with. In summary, to call and arrange a proposed special resolution or extraordinary resolution, 5% of the votes that may be cast at the resolution, or at least 100 members who are entitled to vote, are required. To replace the existing responsible entity with a new responsible entity, an extraordinary resolution is required. 50% of the total votes that may be cast by unit holders entitled to vote on the resolution. To amend the Constitution, a special resolution, 75% of the votes cast by members entitled to vote on the resolution is required. The PaperlinX Investor Group Supporters Committee have formed the view that the incumbent responsible entity is not proactive but reactive. My view is actually slightly more than the responsible entity just not being proactive. I feel they're working against us. They respond to our requests for them to take action with, what do you want us to do? As an example, the PaperlinX Investor Group Supporters Committee made a complaint to the responsible entity on 4 July. The product disclosure statement, which we all invested under, states clearly that the responsible entity will respond in writing within 30 business days of receiving a complaint. Well, today is the 29th business day. Do you think we've heard from them other than taking a week to acknowledge that our letter was considered a complaint? It appears that a member of the responsible entity has not even bothered to log in to our webinar today and listen to what we have to say. We believe that the responsible entity may have made misleading and deceptive statements to investors. However, it's important to note that there are consequences of changing the responsible entity. Should we wish to go down this path, I believe it's achievable. However, we will need to be able to make informed decisions and must be united to ensure we're successful. I will now hand us all back over to Graham for him to provide some closing remarks prior to us commencing our Q&A session. Thank you.
Thank you, Justin. You explained that well, and as folks can see, I had to get the right screen showing. You explained that really well. Seriously, this isn't now just a hybrid problem. It's a whole of company problem. Possibly we, the hybrid holders, will be delivered what I previously termed the Armageddon option, which could easily lead to either a whole of company takeover or dismantling of PaperlinX to the highest bidders in each region, because we saw last year that it was fairly easy to sell individual units of the PaperlinX business. We don't know what's going to happen, but we know that something is going to happen reasonably soon. Now, either of the outcomes I discussed above could also be the best result for senior managers and valued employees. But it would probably mean that the ordinary shareholders will receive next to zero. But I caution, that isn't investment advice, that's just my opinion. As I said, we're all in this together. The hybrid holders, the ordinary shareholders, the management and staff, and particularly those who are entrusted and paid to exercise ultimate control, the board. Maybe these suggestions that I've put on Exhibit 35 will help focus attention between now and the AGM. I urge everyone to read that exhibit at their leisure, which will be on our website. I'd also encourage everyone to carefully read this internal PaperlinX document pertaining to the ethical decision-making process. It's very important. This board has some hard ethical decisions to make. The question is, when will they start making them? Okay, we're now open for your questions to be answered, and because we don't necessarily believe in Dorothy Dix's, I regret to advise we only have one question, and that's been lodged by a gentleman by the name of Darren, and he asks, and I quote, I think I'm the best person to answer this question, has PIGS considered nominating a representative to the PaperlinX board? Well, Darren, the answer is simple. We don't think it's appropriate that we have a board seat for some pretty fundamental reasons. None of us qualify with any proven experience in running a troubled multinational industrial company. Furthermore, Gabby and I are self-funded retirees who were formerly entrepreneurs. That eliminates us. Justin runs a substantial business and would probably have conflicts of interest if he was ever to take a board seat on a public company. And as for Simon and Paul, I think analysts should spend their time analysing and not trying to run companies. I hope that is a satisfactory answer, Darren. I'd like to bring you to a close now by advising that Webinar 2 will be held on Tuesday, August 20th, just 2 weeks away. It will cover the financial year 2000 results, which are due out next week, and registration will open at 9 p.m. Tonight. In closing, I thank everyone for your participation. A copy of this webinar will be available on our website by 8:30 tonight. If you have any further questions, be sure to lodge them on our website. And I extend this invitation to Robert Kay, if you are listening. Perhaps you could call me tomorrow. Let's convene soon with no strings attached. Well, that concludes this webinar. Thanks for your participation and cheers for now.